market commentary for the third week of November 2025. The last week was a little bit volatile, but only down a few percent. This week, or over the past 5 or 6 days, we've seen a more pronounced move downwards. So almost about 6% for Russell 2000 and NASDAQ. But to be honest, Australia, Japan, even Europe, down by almost the same amount. Only, funnily enough, global small caps outside of the US and emerging markets are proving a little bit more resilient. In fact, South America in most places, most countries, in slightly positive territory. But again, if we look at what's happened over the last month, we really only end up where we were a month ago. But there's been a lot of volatility, especially within the US during that period. So the general feeling is that there's a little bit of nervousness around market valuation, especially with limited data now coming out of the US, and this sense of a K-shaped economy in the US where the consumer is suffering and maybe the economy is slowing, but there's been this huge build out in capex supporting AI, and now concerns about the return on investment there. And tomorrow's result from NVIDIA is highly anticipated by the market and is seen as a little bit of a bellwether. Now, almost coincidentally, we've also got two other more consumer focused bellwethers, Walmart and Target, reporting tomorrow and the next day. So maybe next week we'll have a little bit more to talk about both of those themes. But also in Australia, we've seen the local market, and especially if you look over the last month, down 6%, has been on the back foot. Now, the common thread here seems to be valuation. The stock that's led, certainly in terms of contribution to the index, in terms of size and downside, has been CBA, the market darling of prior months so far this year. And that tells us, something that we've been talking about quite a lot, is that valuation seems to be a creeping concern, and it's something that's affecting different markets in different ways, depending on the market structure. In our own market, it seems to be things like Wesfarmers and CBA going up for reasons that people didn't quite understand. And in the US, obviously more AI related, but this sense that there's been a little bit of fizziness. And probably the biggest fall that we've seen is some of those sort of profitless or even revenueless concept AI stocks in the US that have been powering the Russell 2000. So just overall a sense of a little bit of fizziness coming out in the market. Now, whether it amounts to more of that, we'll perhaps be able to talk a little bit more next week. Now, whether it amounts to more than that, perhaps we'll have a little bit more to talk about next week, not just because of those corporate results, but there's going to be some more government data coming out, in particular, the long-awaited non-farm payrolls, which comes out on Friday. But in the meantime, just something to chew on. This is one of the things that's preoccupying markets. This is the Kimi K2 model created by Alibaba. Now, we've taken it for a spin the last couple of days and actually does a very good job. As you can see, the layout here, very like Claude, does a very similar job if you give it the same inputs. But the interesting thing is it costs, apparently it cost a whole lot less, call it 50 million compared to 500 million to build and train. Now, you can argue with those numbers because it's very difficult to verify them. But what does seem to stand up is it costs about 10 times less to actually run. And some of you that use AI a lot might have been noticing recently, if you use Claude or ChatGPT or Perplexity, that you're starting to be metered. So the cost constraints of powering these models, given the infrastructure build out such as it is at the moment and some of the bottlenecks and just the inherent cost of it, is starting to bite a little bit. So maybe this things like the Kimi model coming out of China, and there is some evidence that even though consumers might not want to use this and might not mind paying $20 a month or something for the Western equivalent, but there is some evidence that corporates are looking at these things, because that does represent a fairly significant cost saving. And also they can be run locally, they're open source, etc. So that's a little bit of a thought bubble just around why the market might be asking some questions about the return on investment in this AI infrastructure spend out, and why some of those stocks in the US that are growing fantastically, maybe they could be priced for perfection. Now, lastly, as I said, some stocks in Australia on the back foot. Now, one of the reasons might be is the expectations of further interest rate cuts, quite apart from the fact that this isn't great news for mortgagees, but also for corporate Australia as well. And maybe that's one of the things that's slowing down expectations of future growth. And as you can see here, basically, two cuts that had been expected have basically been taken out of market expectations. That white line on the chart shows where the market expects rates to be in about a year. And if you look at economic forecasts from individual economists, that kind of tallies with that, and they kind of see rates being roughly where they are right now. Now, this week we talk with a bond manager who also has a PhD in inflation forecasting, so quite a useful guy to quiz about this. And we talk a little bit about that, but also about some ways that potentially a bond manager can make money in an environment where you can't really depend on duration or government bonds, potentially, if there's upwards pressure on interest rates. And if you started to see a recession and credit defaults, he's got some ways that potentially you can make some money out of that and provide some defensive returns. Anyway, with more data coming out of the US, some important results coming out, pretty sure we'll have lots to talk about next week. Look forward to talking then.